Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Iman bin Muhammad Saliuddin. You may call me Iman. From class TVA 2424C, here to present an Islamic finance presentation titled Risk Exposure During the Global Financial Crisis, the Case for Islamic Banks. Before we begin, let me start by reciting Surah Al-Fatiha and a hadith. Amin, amin, ya rabbal alamin. Abu Hurairah radhiyallahu anhu reported the Prophet sallallahu alaihi wasallam as saying, "If anyone pursues a path in search of knowledge, Allah would thereby make easy for him a path to paradise, and he who is made slow by his actions will not be speeded by his lineage." Let us begin with the introduction. The current financial crisis that engulfed the world has exposed the deficiencies of the financial system. As indicated by his comments to the Senate Banking Committee in 2003, former Federal Reserve Chairman Alan Greenspan opposed even a minimal level of regulation of emerging markets and instruments. Frank Partnoy, a law professor and expert on financial regulation, observed, "Clearly, derivatives are centerpiece of the crisis, and he, Alan Greenspan, was the leading proponent of the deregulation of derivatives." New York Times, 9 October 2008. This approach to financial markets and products increased the amount of risk that banks had to bear, making them more vulnerable. After the collapse of certain major investment and commercial banks in the United States during the current financial crisis, this became evident. Islamic financial situations, on the other hand, may have been shielded from the severity of the crisis due to Sharia guidelines within which they operate. Currently, banks are using a model called originate and distribute. Under this model, the bank originates loans to borrowers such as mortgage loans and then sells those loans to other institutions such as Fannie Mae and Freddie Mac. The growth of Islamic banking is phenomenal. Since the institution of the first full-fledged Islamic bank in the UAE more than 3 decades ago, Islamic banking has been witnessing tremendous growth. According to most estimates, Islamic banking growth rate surpassed an average 15% in the last decade, and assets under management of Islamic financial institutions are worth close to $1 trillion. Islamic financing is based on the idea that instead of lending money, banks should share risk with their customers. In contrast to a lender's less hedonic mentality, Islamic financial institutions approach their financing activities from the standpoint of the partner. Islamic financing, whether on stock or debt, exposes the financer to greater risk. The core of Islamic financing is equity-based financing such as musyarakah and mudarabah. Islamic banks in musyarakah share financing and management with its clients, as well as earnings based on predetermined percentages. The Islamic bank might operate as a mudarabah or financer. The Islamic bank, as a financer, offers capital to the entrepreneur who will be in charge of running the business. When deposits are made under the mudarabah system, the Islamic bank administers the funds placed by its clients, the financiers. These structurally different financing tools give Islamic banks an edge over conventional ones in terms of risk management. However, even in this case, Islamic banks, instead of lending money as their conventional counterparts do, are involved in business-related ventures with their clients. Under each of these financing tools, the bank will act either as a buyer, seller, lessor, or manufacturer, but never just as a lender. Islamic banks' returns are deemed permissible because these institutions share a multitude of risks with their clients, such as ownership risk, settlement risk, and price risk. Though these are assertions that Islamic banks have a high level of inherent risk, these arguments have little factual validity. Due to the lack of deposit protection, shareholders of Islamic banks should have effective control over the bank's activities, whereas conventional banks are normally protected by some form of deposit insurance, such as the Federal Deposit Insurance Corporation in the United States. On the other hand, it is undeniable that certain characteristics of Islamic banks make them less dangerous than traditional banks. Islamic banking is distinguished by the fact that it is barred from purchasing debt assets under Islamic Sharia law. Thus, Islamic banks are safer from the direct influence of the global financial crisis. Secondly, due to the prohibition of gharar, Islamic banking avoids engaging in projects with a high level of risk. As a result, the prohibition of interest and gharar act as a protective barrier for Islamic banks, allowing them to avoid the direct impact of the financial crisis. Islamic banks will be affected to a certain degree as they are part of the wider global financial system and consequently will be affected by all global financial dealings, even if only in an indirect manner. In a nutshell, Islamic banks were able to withstand the current global financial crisis owing to the fact that their operations are founded on Islamic finance principles. Islamic finance forbids not only interest-based riba transactions but also transactions involving excessive risk, gharar. MBS and other subprime derivatives are extremely dangerous trades that have led in significant losses for traditional banks, notably in the Western world. So that concludes my presentation. If you enjoyed the video, please leave a like and subscribe. Also, if you have any questions, please put your question down in the comments below and I'll try my best to answer them. Thank you for watching. Assalamualaikum and goodbye.